What are some of the most underrated stocks? We put that question to some top investors, and they put together an exclusive list of names they're recommending right now. Coming up in this video, we'll share those picks with you. But first, how did we put this list together? Let's explain, sit back, relax, and hit the subscribe button. It's time for this week's Ticker Take.
It's Ticker Take, you know.
Okay, John, so our theme today is being underappreciated.
Well, in a world where there's so many different stocks, Caroline, sometimes there are companies that just don't get the same attention as others.
Yeah, and there are lots of reasons for the lack of appreciation, but sometimes the biggest one can just be the overall mood of the market.
Very true. I mean, take the sell-off that we saw in the stock market in April. Really was just blanket selling. We spoke to the veteran strategist Sam Stovall of CFRA about that. Here's more from Sam.
So investors said, I'm going to sell first and ask questions later because I really don't know how far this is going to turn. Is it going to be a correction, a 10 to 20% decline, a garden variety bear market, 20 to 40, or a mega meltdown? So they said, let's get out while the getting's still good.
And Sam notes that when you do see that kind of selling, the stocks that end up being the best performers after the sell-off are the ones that were the worst performers during the sell-off.
Yeah, and by the way, we're going to get some stock ideas from Sam's firm, CFRA, later in the video.
Actually, that's a great point, Caroline. Should we get started with our list of underrated, underappreciated stocks from all of today's guests?
Let's do it. But first, these are the opinions of our guests, and
this is not financial advice.
Stock number 1. Alphabet.
Yeah, this pick comes from longtime investor Paul Harris, who's looking at the full value of the entire Alphabet empire. Here's Paul.
It's one of the cheapest stocks from a tech perspective of any of in the tech world, actually. It's trading at around 17 times this year's earnings. The S&P is at 24. Next year's earnings, it's trading at 16 times. It's a company that has $96 billion in cash on their balance sheet, a fantastic balance sheet. It has gross margins of almost 59%, operating margins of 30%, return on invested capital of 30%, over 30% actually. And it pays a small dividend, which is irrelevant, but it really has some really great growth prospects down the road. Not only people are underestimating its ability to grow search. You know, I know people use ChatGPT for a lot of things, but no one puts in, where's my nearest Chinese restaurant to me? It's things like that. Search is very embedded in people's, in all kinds of products. The cloud business continues to grow very aggressively, and along with YouTube continues to grow. And you can see what's happening with YouTube. Not only a lot of you do-it-yourselfers use it, but on top of that, YouTube is becoming a place where people watch movies, but they also watch sports. So YouTube is going to continue to grow from an advertising perspective as well. And finally, you've got Waymo, which is a company that does robo-taxis. And you know, Tesla's talked about it for years, but these guys have actually running robo-taxis in San Francisco, Arizona, and a bunch of other big cities. They have a tremendous amount of data, and that asset is massively undervalued. So you've got these undervalued assets in the company, which will produce some actually great returns. And you've got a bunch of businesses that are continuing to grow. And you're only paying on next year's earnings 16 times for that. So for me, it's a really underrated stock. The overhang on the stock has been the sort of Department of Justice issues. But I think that once those are cleared up, I think you'll actually see Google kind of grow quite rapidly and be one of the best performing stocks in the next couple of years.
Stock number 2. Dexcom.
This company helps people monitor their diabetes. This pick comes from Tyler Ellegard of Gradient Investments.
About a year and a half ago, the stock sold off aggressively on the news that the company changed up their sales force. Now, fast forward to today, that sales force is firing on all cylinders. The company is also making inroads into the type 2 markets and gaining shares. So that is why Dexcom is my underrated pick.
Stock number 3, Dental Corp.
They operate dental clinics. This is the first pick today from veteran money manager John Zechner of J. Zechner Associates.
They're doing a roll-up strategy, which we've seen success with roll-up strategies of Constellation software in slow growth areas of software, and obviously we've seen it in Couche-Tard as well in service stations. Dental Corp is doing that in the dental business as they're starting to buy private dental practices throughout Canada. It's low penetration, probably about less than 5% of these practices have been bought so far. They buy them, they offer the dentist continuing ability to operate under their umbrella, which they look after administration, marketing, a lot of other things, and effectively get a better cost and an exit strategy for those dentists who want to join in. Company is trading at a discount to similar valuations in the U.S., and there's a huge runway for growth on this roll-up strategy over the next number of years. So we think is a stable growth area with a lot of potential upside.
Stock number 4, Dynacor Group.
This one comes from Ryan Irvine of KeyStone Financial. Now, Ryan has 2 underappreciated gold stories to tell you about today. This is the first one. Have a listen.
Dynacor Group is a dividend growth stock that processes ore purchased from small-scale miners at its 500-ton-per-day plant in Peru. The company plans to expand to 4 plants in Latin and Africa, growing production to 500,000 ounces and sales to $1 billion by 2030. With $82 million in cash in the bank and no debt, via a pilot plant in Senegal and a potential mill in Ecuador, the company is well on its way. Dynacor has high geopolitical risk, but you are more than compensated by low valuations, including a trailing PE of 7.8 or 4 times cash out and a growing 3.5% dividend. An underfollowed stock we plan to own for the next 3 to 5 years plus.
Stock number 5, MDA Space.
Well, this is our second underrated name from John Zechner. Here's more on his view with MDA.
These guys are effectively the arms dealer of the space freight with lunar modules, other space components, including the Canadarm, very well known. But the biggest possibility they have to grow is in the low Earth orbit satellite, the LEO constellations that they're building right now on multiple contracts they've added to the backlog over the past year. And this will give them growth for the next 3 to 5 years at least, and we see that continuing. They've paid down all their debt recently. With the free cash flow generation that they're having, they are relatively insensitive to economic movements given these are contracted space spending over the next number of years. It's a discount valuation to comparable U.S. companies, and I think it's pretty much undiscovered, certainly outside of Canada. It's got a great history here, but it's a decent valuation, a great growth space, and like I say, a little bit more immune from the tariff and the macroeconomic uncertainties recently.
Stock number 6, Nutrien.
Yeah, the fertilizer giant. This one comes from longtime strategist Colin Cieszynski. Here's Colin.
From 2022 to 2024, its stock was in a downtrend, underperformed relative to its peers, and generally found itself near the bottom of relative strength rankings within the Canadian investing universe. In recent months, the shares have stabilized below $80 and have been trending sideways, indicating that technically they appear to be building a base that has improved in recent weeks. We've also seen the shares start to climb up off the bottom in the relative strength rankings, suggesting it's starting to attract some renewed interest from investors.
Stock number 7, Orbit Garant Drilling.
Okay, so we go from a company earlier that mills the gold to a company that drills the gold. This is the second pick from Ryan Irvine. Here's Ryan.
Orbit Garant Drilling is one of Canada's largest mineral-based drilling companies, providing both underground and surface drilling within Canada, Chile, and Guyana. We have a simple investment thesis here. Recently, the company exited money-losing operations in Africa and has seen a surge in profitability. Valuations are now discounted relative to peers in an environment where its top-tier gold-producing clients are printing cash. Orbit trades at approximately 6 times our 2025 EPS estimate with growing earnings. If the company returns to peer average earnings multiples, it's worth $2 plus, which is greater than 50% upside.
Stock number 8, Pembina Pipeline.
This one's from Rebecca Teltscher of Newhaven Asset Management, who specializes in dividend stocks. Here's Rebecca.
So Pembina Pipelines has a full value chain and is fully integrated across several molecules, whether it's going to be oil or natural gas, and they're collecting a fee throughout the entire value chain. So if you think about a natural gas molecule that comes out of the wellhead, they're able to earn a toll through the gathering pipelines, the storage, the processing, the fractionation, and then the end market, whether it's going to be through marketing or an export terminal. So they are strategically located in Alberta, and they have access through the Alliance pipeline to the Chicago market for natural gas. or through export terminals through their LPG, so propane export terminals off the West Coast. And they're also working on an LNG terminal off the West Coast as well. So there's lots of catalysts driving their growth right now, whether it's through the Trans Mountain expansion, so more condensate is needed, which they process, or through West Coast LNG, so natural gas, more natural gas is needed. And like we talked about, LPG production that they do the fractionation for. So their take or pay or contracted revenue is about 80 to 90% of their total EBITDA, and that's what pays the dividend. So their dividend is about a 5% dividend yield. They just raised their dividend 3%. They're going to continue to grow their dividend, and that's backed on their fee for service. So there's no commodity price exposure on those revenues, and whatever upside they get from commodity prices is just a bonus, but it's not that consistent cash flow. So we think at these valuations, Pembina is pretty undervalued and has a lot of growth potential over the longer term.
Stock number 9. Thermo Fisher Scientific.
This is a pick from Brianne Gardner of Velocity Investment Partners at Raymond James. Here's more from Brianne.
This isn't just a biotech powerhouse. This stock powers things from behind the scenes with $42 billion in annual revenue, partnering with some of the top pharmaceutical companies, providing tools that make drug discovery and diagnosis possible. The stock recently hit a 52-week low, weighed down by tariffs and potential slowing of U.S. spending. However, revenue and cash flow still remain solid. We see the stock down 37% off its highs. So again, looking at short-term underperformance here and trading below industry average of price to earnings. So a significant discount of fair market value. On the street, we see analysts have an upside of 35% and a price target of $570 per share. Ranks a 10 out of 10 fundamentally and a buy overall on the street. We see this as a high quality name that the market is undervalued.
Stock number 10. Tourmaline.
This one comes from longtime strategist Greg Taylor, who's been keeping a close eye on energy stocks recently. Here's Greg.
We're looking for areas of opportunity that are really underpriced. I think you don't have to look much farther than the energy stocks. This energy stock sector has been completely ignored by global investors for the last 10 plus years. It's had to go against a lot of big threats, from the threat of EV vehicles taking on demand. ESG took away a lot of people out of the sector, and just the whole fear that we're not going to use as much energy going forward. I think a lot of those fears have really been proven wrong right now. We're still seeing an increase in demand for oil and natural gas, and these sectors still really haven't done too much. So there's some great opportunities in these stocks, and I don't think you get to look too far down the cap structure. You can really just go with some of the larger names. C&Q is still one of the best in class operators, but Tourmaline would be my pick as something that I think you can really hold for the next number of years. It's one of the best in class natural gas operators in North America. Good valuation, very good free cash flow, and also just great management teams to keep this company going. And at the end of the day, you also get a nice dividend. So a lot of things going right for it, good valuation, and I think these energy stocks are setting up some good opportunity, especially as we're starting to see some M&A in the sector. So this is a great opportunity to show that these energy stocks are just too cheap to ignore right now.
Stock number 11. United Health.
Well, we've heard a lot about this stock recently. This one comes from Adam Johnson of the Bullseye Brief. Here's AJ.
When great companies stumble, you buy them. And for the biggest stumbler right now, look no farther than UNH, United Health Group, ticker UNH. Stock has gotten absolutely crushed because everything that could go wrong has gone wrong. The CEO was murdered. The interim CEO has stepped down. The company cut guidance. The DOJ is investigating its Medicare pricing. And yet, the good news? The old CEO, Steve Hemsley, the guy who ran this company for a decade and built it into what it is, the largest healthcare insurer here in the country, he's back. He's going to take the reins, and he promises to return to 13 to 16% earnings growth sometime next year. With the valuation a fraction of where this company has historically traded, I'm a buyer. UNH. When great companies stumble, you buy them.
Stock number 12. Vertiv Holdings.
This one comes from longtime tech investor Kim Bolton, who's watching the plumbing layer tied to the AI revolution. Here's Kim.
You know, it's quietly been performing, but it's definitely an under-owned opportunity. This has to do with cooling in AI and high-performance computing data centers, right? So the conventional way of cooling for CPUs and GPUs was air cooling. However, now that you have these very, very powerful GPUs that are coming out from the likes of NVIDIA and AMD and Broadcom, that air cooling is not efficient and effective. The big thing that people have been working on is this liquid cooling. And if you know Vertiv, this, they're the king of this stuff. And I think it's going to go a heck of a lot higher, because even the PEG ratio at 26 times forward PE, the PEG ratio is implying 1. And actually in this business, the average is actually 1.5. So in other words, it's got a pretty lucrative runway going forward.
And finally, our underrated stock bonus, 10 more stocks.
Well, earlier we heard from the strategist Sam Stovall of CFRA. The analyst team at CFRA has been monitoring the markets for underappreciated names. Some have bounced off their lows, but those stocks include General Motors, Vistra, which is a power play tied to the AI boom, Marvell in the chip sector, MGM Resorts in the airline sector, UAW in the apparel space, Lululemon, financial services, private equity firm Apollo comes to mind, Best Buy, Nike, and finally LyondellBasell.
All right, that's our list of underappreciated stocks. A big thank you to this week's guests for their investment ideas.
Absolutely, and if you want to learn more about any of our guests, we've included some information about them in our description.
We'd also love to know what stocks you're watching. Let us know in the comments, and please let us know any video ideas you have for us.
Speaking of which, we hope you liked this video. If you did, make sure to share it, and don't forget to subscribe so you don't miss our next investing video. See you next time.